Welcome back to the Wall Street Podcast. For our deep dive today, we're digging into BofA Securities Commodity Portfolio Strategist Monthly. This report just came out August 3rd, 2025. It's pretty comprehensive, covers the global commodity outlook, dives deep into what's been happening with copper, and touches on those broader economic signals. Our goal here is simple: extract the key insights you need to understand current market trends.
Exactly. And BofA offers some, pretty specific projections and interesting analysis, especially on how markets react to policy shifts. It's quite timely.
Good. Let's start with that global outlook then. What's the one-month view from BofA? What are they seeing in the near term?
Okay, so for the next month, their models are actually bearish on crude oil and gas oil. Suggests they see prices potentially falling, or maybe weak demand. But conversely, they're overweight gasoline, soybean meal, silver, and gold, expecting outperformance there. You've also got specific positive roll yields flagged for Brent, gasoline, lean hogs, and sugar. That implies, some profit potential just from holding those contracts as they near expiry. Tightening markets, maybe. On the flip side, though, negative excess returns are projected for WTI, Brent, and gas oil. So underperformance beyond just the spot price movement.
Okay, that's the one-month picture.
Yeah.
What if we look out further, say 6 months? Does the view change significantly?
It does shift, yes. Over 6 months, the models are projecting positive spot returns for the energy complex generally, live cattle too, and most agricultural commodities. And for positive excess returns, they're looking at Brent again, gasoline, gas oil, heating oil, nickel, zinc, silver, soybeans, and soybean meal. But interestingly, negative excess returns are still expected for WTI alongside live cattle and aluminum over that 6-month period.
Right. And all these projections, they don't happen in a vacuum. What's the macro picture BofA is considering? Fed policy, trade?
Well, the Fed kept rates on hold back in July. Chairman Powell's comments, though, were seen as pretty hawkish. So caution on future rate cuts seems to be the signal. Then there's trade. Tariff negotiations are ongoing. BofA notes that even with uncertainty maybe decreasing slightly, the risks of stagflation are reinforced. They see effective tariff levels settling around 16%. And there was that U.S.-EU trade agreement exempting some sectors like aircraft, chemicals. But the analysis suggests it'll still be a drag on the EU economy overall, facing an average tariff rate of about 15%.
Okay, so a cautious Fed, complex trade deals. Against that backdrop, the report really zooms in on copper, doesn't it? It's seen some incredible volatility. What kicked that off?
It certainly has. The big trigger was on July 8th. The Trump administration, quite unexpectedly, announced 50% tariffs on copper. The justification cited was national security, semiconductors, data centers, even ammunition, critical inputs. And that announcement just immediately sent shockwaves through the market.
50% is huge.
Yeah.
How did the market react? Especially thinking about the price difference between London, the LME, and the U.S. exchange, COMEX.
Oh, it caused a massive divergence. COMEX copper futures, so the U.S. price, shot up over 13%, hit an all-time high, actually, $5.70 a pound. And the arbitrage, the price gap between COMEX and LME, it ballooned to 30% of the LME price. Just a huge, huge dislocation. Really unprecedented.
30%.
Wow.
But that didn't last long, did it? The arbitrage just seemed to vanish.
Vanished is right. On July 30th, another surprise, copper cathodes were excluded from the tariffs after all. The market reaction was immediate and brutal. COMEX prices plunged 22%. The report calls it a 13 standard deviation event. I mean, that's statistically almost impossible, extremely rare.
A 13 sigma move. Incredible. And that kind of shock and reversal must have done strange things to actual physical copper flows and inventories.
Absolutely. In the lead up to August 1st, when everyone expected the tariffs to hit, there was this massive rush to get copper into the U.S. The result was something like 600 kilotons building up in U.S. inventories. That's nearly 40% of annual U.S. demand, just sitting there. And at the same time, LME warehouse stocks were being drawn down to feed that rush. Consequently, you saw the LME futures curve flip into contango futures prices higher than spot, suggesting near-term abundance. COMEX forwards, meanwhile, stayed in contango.
Okay, so we had this wild ride, tariffs announced, huge price spike, tariffs partly reversed, massive price crash, inventory surge. Given all that, what's the strategic opportunity BofA sees now?
Well, they see value in a systematic mean reversion trade, basically betting that the LME-COMEX copper spread will eventually revert to its historical average. Typically, metal starts physically moving between the exchanges when that spread gets wider than about $100 to $200 per ton.
Right.
That tends to pull the prices back together. And even with all this inventory currently sitting in the U.S., the underlying demand story for copper, EVs, data centers, new tech, it's still supportive longer term.
But is the tariff threat completely gone? Are there lingering risks that could potentially disrupt this mean reversion idea?
That's a key point. The report stresses that tariffs aren't entirely off the table. There's a presidential review scheduled by June 30, 2026. That review could potentially lead to phased import duties on refined copper kicking in later, maybe 15% starting January 1, 2027, then jumping to 30% from January 1, 2028. And BofA suggests this future risk, this possibility, is already visible. You can see a sort of kink, an unusual bend in the forward price curves between the two markets way out in the future.
Okay, so a potential trade, but with some future policy risks still baked in. Let's zoom out one last time. How might all these trends, copper volatility, the broader stagflation risks, actually impact people's everyday lives?
Well, copper is fundamental to so much modern technology, semiconductors, data centers, all the electronics and smart devices you use. So sharp price swings can eventually filter through to the cost of those goods. And more broadly, the stagflation risks we talked about, often linked to things like tariffs, they could subtly push up prices across a wider range of consumer goods and services. That affects household budgets, general economic stability. It's all interconnected.
It really is. It makes you consider how global trade policies, combined with rapid technological change, are constantly reshaping these fundamental commodity markets. And that impacts everything, from the phone in your pocket to huge infrastructure projects. Thank you for joining us on this deep dive. We appreciate your valuable time.